All right, let's dig into Brookfield Asset Management's Q4 2025 earnings call. The stock had a huge reaction to the news, and we're going to break down exactly what got Wall Street so fired up. Let's get right into it. So, here's the big question, right? For most of the last year, Brookfield has been a serious laggard. I mean, it's been a frustrating stock to own. But then, after this one earnings call, the stock just shoots up nearly 5% in a single day. What on earth did they say that completely flipped the script for investors? And I mean, just look at the context here. It is stark. Over the past year, you had the S&P 500 climbing over 12%, while Brookfield shares just tanked, down almost 16%. That is a massive, massive difference. This backdrop of investor frustration is exactly what makes that 5% pop so important. Something big had to have changed the narrative.
Okay, so to find that narrative, we have to start with the numbers. But as you're about to see, the headline figures everyone saw at first, they were actually pretty mixed. The real story? Well, that was buried a little bit deeper.
So here are those top-line results. Earnings per share came in at 64 cents. That's a solid beat against the 59-cent consensus. Nice. But look at revenue. It missed. It came in at $1.9 billion instead of the expected $1.96 billion. So a beat on earnings, a miss on revenue. You know, that's a mixed bag. And that usually doesn't spark a major rally. And that tells you everything. It tells you that the market was looking right past those headline numbers and focusing on the real engine room of the business. So let's break down the three metrics that truly powered this move. First up, fee-related earnings, or FRE. Now, this is the good stuff. This is the high-quality recurring revenue that asset managers live and die by. BAM posted $867 million, up a staggering 28% year over year. I mean, wow. That signals powerful, predictable cash flow growth, which, as you know, investors absolutely love to see. Second, fundraising. Now think about the environment. It's been tough for a lot of firms to raise capital. Well, Brookfield pulled in a record $35 billion in a single quarter. This is just a massive vote of confidence from their clients, and, more importantly, it's the dry powder that's going to fuel their future fee-related earnings. And third, they're giving cash back. Management boosted the quarterly dividend by 15%. You know, a company just doesn't approve a double-digit dividend hike like that unless it is extremely confident about its future cash flows. This was a direct signal to the market saying, hey, the strength you're seeing, it's built to last. So, if those numbers were the fuel, this next theme, this was the spark that lit the fire. While a lot of other companies are kind of worried about AI disruption, Brookfield is positioning itself to build the actual physical world that AI is going to run on. And believe me, they are not thinking small. The new CEO, Connor Teskey, put a number on it, $100 billion. This isn't just about building a few data centers here and there. No. This is about dominating the entire ecosystem that powers artificial intelligence. This right here is the multi-year growth story investors were starving for. And their strategy is just incredibly comprehensive. They're not just some landlord for data centers. They get involved from the very beginning, securing the land and, this is crucial, securing the power. Then they build the facility, they help fund the servers and the chips inside, and then they deliver the whole thing as one integrated package. It's a classic picks and shovels play for the AI gold rush, but on an absolutely massive scale. You know, during the Q&A session, management really hammered home a critical point. The biggest bottleneck for AI's growth right now, it isn't a lack of money, it's a lack of electricity. And this is where Brookfield sees its ace in the hole. Their deep expertise in global power and renewables gives them a huge competitive advantage in solving this exact problem for their clients. And look, they're not just talking about it. They're immediately putting their money where their mouth is. They've launched their first dedicated AI infrastructure fund with a $10 billion target, and it's already halfway there, with $5 billion in commitments right at launch. So this isn't some far-off plan. It's a strategy that clients are already buying into right now. So they've got the numbers, and they have this massive new growth story. But the big question is, can they execute? Well, the final piece of the bull case from this call was all about reassuring investors of stability and proving they have a repeatable process for success. First up, the leadership transition. Chairman Bruce Flatt made it crystal clear that appointing Connor Teskey as CEO wasn't some big shakeup. He basically said it was just a formal recognition of the job he's already been doing for years. The message to long-term investors was clear. Expect continuity, not drama. Just get ready for execution. And this all feeds into management's core pitch.
They're trying to say they're not just making one-off deals. They've built what they call a manufacturing system. They raise record amounts of capital, they deploy it with discipline, they sell assets at a profit, and then they return that cash to shareholders. It's a value creation flywheel that they believe can just keep compounding for years and years.
Okay, so that's the story we got from the call. Now let's put it all together and look forward. What does this all mean for the stock between now and the next time they report? Well, the bull case is now pretty clear. You've got this massive AI tailwind, their core earnings are accelerating, and their platform is an absolute capital-raising machine. The bear case is also pretty straightforward. Hey, this is a stock with a history of underperformance, and there's huge execution risk here. I mean, can they really deploy $100 billion effectively into a brand new theme? That is the key question. Our take? The narrative here has fundamentally shifted. The combination of that accelerating FSRE, a massive dividend hike, and a credible multi-year growth story in AI infrastructure, it's just too powerful to ignore. We believe the catalysts are now in place for the stock to finally break its long trend of underperformance. Our rating is outperform.
So, for the trade idea, look, this isn't a quick flip. The AI build-out is a multi-year story. So, one way you could express this view is through long-dated call options. This strategy could potentially capture the significant upside from the AI theme over the next, say, 18 to 24 months, while taking advantage of the fact the stock is still well off its highs, which could make those option premiums more attractive.
And remember, all of this is for informational purposes only. It is not financial advice. You should always do your own research and consult with a professional before making any investment decisions.